Hi, I'm Stan, the Annuity Man, America's annuity agent, licensed in all 50 states, including yours. I'm doing these retirement lifestyle videos because people are always asking me, Stan, do you have anything I never lose money in? I mean, everyone says they have it. Annuities are contracts, so we're going to go over the ones that you can never lose money, which is a good thing in the volatile world that we live in. And the stock market's great if you can handle that risk. And for people that are, young, they need to be there. But for people that are kind of reaching retirement age, or kind of seeing the finish line for retirement. In fact, 10,000 baby boomers reach retirement age every single day. A lot of them are looking for contractual guarantees, and a lot of them are looking for products that they cannot lose a penny with it at all, regardless of what happens in the world and the markets, et cetera, because they've worked hard for their money. I mean, they really have laid it on the line over all these decades, and now they're at the finish line, and they just want to hit bunt singles. They just want to do the pragmatic thing and never lose a penny. I'm going to show you how to do that after this video. All right, so before we get started, I'd encourage you to go to theannuityman.com. You can schedule time to talk with me. If you're considering an annuity, you need to talk with me. I'm the top agent in the country, licensed in all 50 states, representing pretty much every carrier out there. I've written these 6 books I'd love to send you for free and under no obligation. They're owner's manuals. They're easy reads. In fact, they're very thin because I got to the point, no fluff, kind of like these videos. But I would encourage you to go to The Annuity Man. I put out a podcast every week called Fun with Annuities, in addition to these videos every Monday through Friday. All right, so let's go over some annuity types that you can never lose a penny, and that sounds good. Now, anytime there's principal protection on a product, that's going to limit the upside. So if you want market growth, go buy market stuff. Go buy stocks and ETFs, mutual funds, etc. And there's nothing wrong with that. But for people that want to fully protect the principal, annuities are a good place to go. Let's talk about the first one. It's called a multi-year guarantee annuity. It's a CD type annuity. It's basic. It's a fixed rate. It just works like a CD. You give the money to an annuity company. They pay you a specific interest rate for a specific period of time that you choose. Sound familiar? Yeah, it's a CD. The difference is with a multi-year guarantee annuity in a non-IRA account, the money grows tax deferred. Yes, you have to pay taxes when you pull it out, but if you want to just hit these bunt singles and get this baseball analogy, bunt singles, very simple, very easy to understand, fixed rate for that specific period of time, but you want to use non-IRA money, it works. You can also put multi-year guarantee annuities inside of an IRA, but you're just going to be getting that contractual guarantee. There's no double tax deferral because an IRA is already tax deferred. So a lot of people say, well, I'd never put an annuity inside of an IRA. I disagree with that. When it comes with annuities, you're buying the contractual guarantee. So the contractual guarantee works in a non-IRA, a Roth IRA, a traditional IRA. The difference is if you pull money out, you're going to be taxed differently based on the account you're in, but you're buying annuities for the contractual guarantee. So, multi-year guarantee annuities, fixed rate annuities. We have a live feed at my site at theannuityman.com. I would encourage you to go there. You just have to punch in your state of residence, the duration that you're looking at, and boom, you're going to see all carriers listed with the highest interest rate for that specific period of time that you choose. So that's a good way to go. All right, another product that you can never lose money, never lose a penny, regardless of what happens in the market, is the ever popular, overhyped, oversold, overpromised, overpitched fixed indexed annuity. I know you're like, oh, Stan, I thought you hated fixed index annuities. No, of course I don't. They're a pretty good product when you fully understand what they are designed to do. And they were designed in 1995 to compete with CD returns, not market returns. I know that's not the pitch you heard. You hear market upside with no downside and market participation with principal protection, all this great stuff. And if all that was true, the Fed would just buy indexed annuities. They're CD products. They're very good, efficient delivery systems for what's called an income rider benefit as well. But if you just bought a fixed indexed annuity, it is a life insurance product, a fixed annuity issued by a life insurance company and regulated and approved at the state level. You're never going to lose a penny. The good news is that the CD type returns lock in. So if you have an indexed annuity that has a 1-year contract anniversary date on the call option, you're just going to lock in those gains. Again, you're not going to get those stock market type returns, but you are going to get CD returns, which is a good thing. And if the market goes south, you're not going to lose a penny. And let's just look at that same example where you have it ratcheting, locking in. If the market goes south, you've locked it in. You're locking in every contract anniversary, or most indexed annuities that we look at have this 1-year point-to-point type look. And by the way, I've done a videos series on fixed index annuities you might want to take a look at as well that explains all the spreads and caps and participation rates when it comes to index annuities. But index annuities are a principal protection product. So when people say market upside with no downside, half of that's true. It's the no downside part. If they say market participation with principal protection, half of that's true. The principal protection part is right. So they might fit for your specific situation. You might combine them with multi-year guarantee annuities, but the bottom line is they protect the principal. Okay, so you never want to lose money. I get that. Now let's talk about income annuities. So single premium immediate annuities, deferred income annuities, qualified longevity annuity contracts. They're annuitized products. Now, when you get income from an annuity, it's primarily based on your life expectancy at the time you take the payments. Interest rates play a secondary role. That's including with income riders as well, which we just talked about with the indexed annuities. Now, once you turn on that income stream, you're getting your money back with interest. Okay, so it's deducting from the principal. So when you say principal protection, this is kind of a little bit of an asterisk. What I can tell you is that we can structure the policy with these lifetime income products so that 100% of the money is either going to go to you or it's going to go to your listed beneficiaries, and the evil annuity company is not going to keep a penny under any circumstance. A lot of people call me up and say, I'd never buy an annuity because when I die, money goes poof. Well, that's one out of about 35 ways to structure it, but we typically don't do that unless you tell us to. That's the reason you got to contact me or go to theannuityman.com and set a time to speak with me one-on-one so I can get your specific goals in mind and then go shop the best carriers for the best contractual guarantee for your situation. But the bottom line is with these lifetime income products like single premium immediate annuities, deferred income annuities, qualified longevity annuity contracts, and income riders, the annuity company is on the hook to pay regardless of how long you live. You have transferred that risk to the annuity company and they are on the hook to pay. So if you live to 150 or 170 or 180 or whatever, they're on the hook to pay. I always tell people there's no return on investment ROI until you die. I don't know what that ROI is until you die. Up until then, it's a transfer risk. Now, what we can say about principal protection on these products is just that 100% of the money that you initially put in is going to go to someone in your family. We will structure it that way, even though the annuity company is on the hook. So that's a little bit of an asterisk because most people, when they say, I never want to lose a penny, then they're talking about the multi-year guarantee annuities or the index annuities where the principal's protected. You're never going to lose a penny. You still control that asset. But I also think that principal protection can be, when fully explained, applied to these lifetime income products because most people think that the money goes poof when you die. It doesn't have to be like that. We can structure it so that 100% of the money goes to you or your family regardless of what happens or the circumstances, and if you live forever, the annuity company's on the hook to pay. So I'd encourage you to go view my retirement lifestyle series. I've done a lot of these and going to do a ton of them. If you want to make a comment down below, you certainly can. If you have a suggestion on a video that you want to see me do, I will do that. I encourage you to go to theannuityman.com and schedule a call with me one-on-one, and we can talk annuities and talk strategies to see if something fits. I'll even tell you if it doesn't. Please hit the subscribe button, and I will see you on the next Stan the Annuity Man video.